What is way worse than the interest rates going up? We all know that interest rates are pummeling the economy. It's pummeling different people. People are losing their jobs, their houses, their businesses. So what is worse than these interest rates going up? That's what we're going to be getting into today, and how that you can hedge against something like that. All right, we got to know how much of this is coming up on an everyday language. Let's try to pay attention to Jerome Powell and see what he is saying about it right away. All right, here he is.
We've covered a lot of ground, and the full effects of our tightening have yet to be felt. In light of how far we've come in tightening policy, the uncertain lags with which monetary policy affects the economy, and potential headwinds from credit tightening.
Did you see? And potential headwinds from credit tightening. And so I've had this question over and over and over again about what is credit tightening and how can we avoid this? Because I can tell you right now that credit tightening is far more dangerous than these interest rates. And we're going to be getting into a little bit of that today. What is this credit tightening and how is it going to affect you? Because there is not a single person in Canada, where I am, in the United States, that is not going to be affected by this hugely. I'm going to show you a couple other things, and then you can ask me some questions along the way. That's why I love doing lives with you guys, because we love trying to learn together and get ahead. What is tight monetary policy? We got to know this because this is really, really important for us. Tight monetary policy, or tight when they talk about it, is contractionary money supply, so they can get rid of money, which we know the United States is doing by the central bank and the Federal Reserve to slow down overheated economic growth. Number one, you know that I do not agree with this. We think that the economy is actually shrinking, but they're not telling us we are in recession, but they are still raising rates into it. Tight monetary policy can be implemented by selling assets, which we know that they're doing. Also, if you want to go down, rate increases make borrowing less attractive. You and I have all seen the interest rates going to the moon, and they may increase reserve requirements at certain banks. You guys know that I'm in Canada, and the Office of Superintendent of Financial Institutions, for example, tripled the domestic stability buffer. It used to be 1% of all loans. There has to be money put aside in a special account just in case something goes bad. Now they tripled it in December up to 3%. Interestingly, you see right here on refining how they do risk, when you open up that, there is a sentence that is here. As such, we are willing to accept the orderly failure of a regulated institution. So you have to understand that this is the banks, the government's own website that are saying that they are willing to have a total crash. And so what is this loan tightening? The loan tightening means that they will not lend mortgages at all. They will not lend mortgages. Now, do you know, can you even imagine, even for a second, what do you think would happen if no loans happen anymore? I can tell you already, the economy will grind to a halt into crazy town. Okay, I'm talking Mad Max kind of world. I want you just to imagine that for 1 second. What on earth could possibly happen if that actually happened? Number one, zero mortgages. Only 10% of people buy homes in cash, so that would just disappear. All businesses have to have a loan to buy the equipment, to buy inventory. All people that buying homes with their mortgages, people who are putting stuff on credit cards. Imagine for a moment if that didn't happen. Screeching halt. If you're a business owner, you know right away you would be in serious, serious trouble. And so this is where we are running into this type of situation right now, where people cannot get mortgages. But you wouldn't know that from looking at average home prices where I live, where they were at $1,089,000. They dropped down to 980 over the past 12 months and have just been on an absolute tear. Absolute tear. This right now, this is what I would say is where we're sitting right now with the economy, that we are playing a game of chicken, and the governments are telling you, you are going to get smacked down, and the public are buying up stocks and buying up homes like it is Party Tuesday. I mean, they're not stopping for a second. Now, let me give you this little idea. I have this really cute niece. She just decides to stop pooping. She doesn't want to poop. And her mom says, I'm going to win at the end of the day. And she puts a little bit of laxative in for her to go to the bathroom. And she just refuses. And the next time she gets another scoop and another scoop. And the mom's just sitting back going, I know that I'm going to win here. At the end of the day, it's going to happen. The poop Olympics is coming, right? The economy is kind of like that stubborn kid who just does not want to give in, but the government has the tools, and the government is going to keep going, keep going, keep going until there's going to be a loss. And that loss is breathing down everyone's necks right now. All right, so they're trying to play that game of chicken, but there's no way that they're going to win. Like I said, prices are going absolutely bananas. The top 8 stocks in the S&P 500 are going absolutely crazy. People are selling homes way, way faster now, 15 days on market, which is unbelievable, right? This is crazy. And so we have to know that this is going to be continuing, how they are going to be raising this risk. And just please go to Investopedia to try to take a look at that. Now, it also says that tight monetary policy is different because it can be coordinated with tight fiscal policy. So do you print money for inflation or not? Or does the government spend a lot of money or not? Two different things that they can happen at the exact same time. Monetary policy is, do they print and invent money out of thin air? Or tight fiscal policy, where they're not going to be spending as much. And this is where the governments are coming into right now. We're into some serious, serious trouble. As you know, Canada has egg on their face. They raise those interest rates up and then they pause those interest rates. Why on earth did they pause them? Who knows? They did it prematurely, and now they look a little bit dumb because they've had to raise it back up again. Whereas the United States, we know, have raised the rates right up 10 times in a row before their pause. So our dollar, if we look back just in the past year, has been quite volatile, but it has stayed lower in this region because of that policy mistake that they had made. All right, guys. So if we want to take a look at what's going to happen in the future, we're probably going to be seeing these interest rates in the United States raise. 74% chance right now of those policy rates actually going up in the US, which means that Canada, who follows the United States, is most likely going to have that as well. We're having a massive inversion in the interest rates. And so this interest rate, when your fixed interest rate is lower than your variable, this is telling you credit tightening. They are not going to be giving out mortgages. Also, we're going to be covering a little bit about the Fed effective rate. We're going to be jumping into that in a second. So you guys, I want you to understand where we are in the stream of time right now. I'm very, very, very worried for you. If you guys like this type of information, please follow the channel, click subscribe on it. It would really mean a lot to me, and send it to your friends because I'm trying to get the word out to as many people as possible. I want the least amount of people to get hurt. So let's take an example of the situation that we are in right now. So we're going to take this interest rate and we're going to apply some rules. These are the rules that you have to follow. The rule is 1% interest is 10% of the price. So that means if you had a home that was worth $1 million and then interest rates went up 1%, that means that your home would drop 10% in price. Just go to any calculation, any mortgage calculator you want online, and you're going to see that. In addition, 30% of after-tax income can be used for shelter. This does not change 70s, 80s, 90s, 2000s right now. It's 30%. So let's take that into effect and let's run a real example. If you make $100,000 a year, you pay 30% in tax. We're just using round numbers. You make 70,000, right? 70K. Now you want to know what is 30% of my clear 70,000 that I make. That comes out to 21,000. Is that right? I think it should be a little bit more, but that's the number I used. But just so you have the idea, I think I was just doing it quickly. So if I make 21,000, which would be a touch more, I think if you divide that by 12 months, it's going to give you your 1750. That is how much that you can spend on your shelter. It doesn't matter what the price of the home is, doesn't matter what the interest rate is, doesn't matter. What matters is that it's 30% of your take-home money. Okay, that never changes ever, ever, ever in history. So that's a good rule for you to understand. So let's just take into effect how credit tightening is about to destroy millions of people. And I cannot be more serious about this. This is really, really bad. So let's just take this one example. I put my wife here with 2 little bambinos, really cute kids. Don't laugh at my drawings. But let's just say in 2022, the couple made $150,000. They made $100,000 after tax, clear, and they had a 700 credit score. Okay. Their income and their credit score are very good and they're happy. Notice here on the left, I wrote that is prime 2%. Like, so this is the advertised really good interest rate at the time. So if they last year in 2022 up top, if in 2022 they were able to get a $750,000 loan at 2%. So notice their credit was good, 100K clear, 700 credit score, and they got a loan at 2%, right? But that's what they're advertising as well. Now let's fast forward 1 year and see what's happening. They're advertising 5.5% on the side. 5.5 is what they're advertising. But in 2023, guess what? They're still making $100,000. They're still making 100 grand after tax. Hasn't changed. They're still have a 700 credit score. Good for them. But the bank then says, guys, we're only comfortable giving you a $400,000 loan at 10%. 10. And when they see that, that's when everybody's jaw hits the floor. And I mean, they go, what is that 10? I see you advertising 5.5. I want 5.5. Please give me the 5.5 back. But for some crazy reason, right? They're not like, nope. We're not doing it. Credit tightening. What does that mean? It means that the banks don't want to lend out mortgages anymore. They have a lot of cash. They're happy putting their money in reverse repo and making 5% on their money with zero risk. Whereas why are they going to try to lend you money and not even make 5% on it? It's not worth their time. They'd rather put billions aside for all of the problems that are coming. And they know that commercial real estate, residential real estate, they're putting tens of billions aside into accounts for loan loss provisions because they see the writing on the wall. And so this is not an example that I'm just coming up with. This is actually what is happening right now. We know people in this situation right now where they had a loan at 750,000 up here. And then when they come for renewal, the first shock is they will not get the $750,000 anymore. They say we're readjusting our amount based on the new rate and based on our new lending standards. They would rather you have an 800 credit score, but you only have 7. They would rather you have $200,000 in after-tax income, not 100,000. And well, you know what? While we're wishing for things, wish for a golden toilet. I don't know what to tell you guys. The banks are being unreasonable now, and they're only going to give you a loan at 10%. That is the best case scenario. Even myself, I do pretty well for myself, and they were offering me some mortgages at some of the banks I use at 9.5. Crazy. So let's continue on. This is a guy that we ran into this week. He has a condo. He has a $400,000 mortgage at 2%. Okay. And it's coming up. I think he had it for 2 years that was locked in at 2%. And now it's coming up for renewal. He still has his job. I need to reemphasize that. He has his job. His job has not changed. His income has not changed. His credit has not changed. Nothing has changed. Okay. So he had a mortgage. He locks in the rate for 2% for 2 years. And then when it comes up, now he's got to go back into the bank and renew it. In the United States, you can do it for 30 years and you don't have to go talk to the bank anymore. In Canada, for some crazy reason, we are now going to we have to go in every 2 years, 3 years, 5 years, whatever, something, but we constantly have to renegotiate the deal. So basically everybody in Canada is on some form of variable somewhere. And so the banks are going to nail him. And did they ever? So he was at 2%. Notice the board here that he was at 2%. Okay. Now, when he came up to renew with his bank, the bank would not renew with him. Absolutely not. Same income, same credit, exactly the same. And when that happened, guess what he had to do? He had to go get a third-party loan. Kind of sounds like a loan shark, does it not? That he goes there, and now they gave him a 12.9% mortgage with a 2% orientation fee. You have to understand what that means. Can you imagine paying? He's got to go now pay $8,000 just as a fee, $8,000 just to get the mortgage for a 12.9%. That's this week, you guys. If you're not paying attention to what is happening with credit tightening and loan tightening, you're on another planet. You are going to get smushed like a cockroach. Isn't that what Kevin O'Leary always says on Shark Tank? He says that you guys are going to get squashed like a bug. And this is what the banks are doing right now. And people are not paying attention to it. And I want people to be safe. This is really, really scary for me. So let me show you a couple other screens. The interest rate is nothing. Forget about the interest rate. I mean, it's important, but who really cares in the grand scheme of things? So let's take a look right here and look back in the 70s, 80s, 90s. Remember, the gray bars here are recessions, okay? Gray bars are recessions. But you have to remember that this one pot here in 2020, this tiny little skinny spot right there is what the last thing that happened and the only thing that people remember. You have to remember that in a recession, the banks are out of cash. They're in big trouble. So they are not willing to lend money to anybody. I have to repeat that. When money is cheap, it does not mean money is loose. When money is cheap, when the interest rate is low, it means they usually are never lending anything. Please go back to the 50s, the 60s. You'll see the interest rates up and it drops. When it drops, the rate goes low. They only lend that money to very large institutional buyers. We'll see the interest rates up, it crashes down. And during this time, they don't make loans to the public, only to people like Jamie Dimon. This happens every single time. If you want to be in the 70s, the 80s, the 90 drop, 01, 07, when those happen, you cannot get a mortgage. I'm dating myself by telling you this because I remember in 2008 and 9 and 10, people that I knew that had houses that they owned 100%, all cash. They got great income, they own their homes in cash, and they go to get a mortgage. No. What about even 50%? I'll keep 50% the equity myself, only give me a small loan. No, we don't give out mortgages. This is a much bigger danger than what is going to happen just with the higher interest rate. I'm not saying the interest rate is not a killer. It's a massive killer. This is just an even bigger killer. Now, we're seeing these warnings come all over the place. So I want to show you some warnings that you can look up so that you can feel interested. Now, when you lend money to the government, you can lend the money to the government for 1 year, 2 year, 5 year, 10 year, whatever you want. Okay, you choose the time. But what you can do is, this is what they call yield curve inversion. When the 2 year, if you only lend the money to the government for 2 years, you expect a smaller interest rate. If I'm going to lend it to them for 10 years, I expect a huge interest rate payment. But what happens in this case? Okay, let's dig into that. Do you see that when it got inverted here back in 1980, that we were in a recession? Do you see when it gets reverted right here, 1981, we hit a recession? Do you see right here in 1989, it's giving us the warning, then there was a recession? Do you see here in 2000 that it went inverted and then there was a recession? Do you see here in 2007, then there was a recession? Do you see in 2019, even before the shutdowns happened, there was that warning sign and then there was the recession? Look at where we are today. It has not been this bad since like 1981. So you have to understand that this is flagging you that there is a lot of problems coming. Not only this, we're seeing the interest rates pound people and we're seeing credit tightening as well. That's a big problem. If you want to look at the interest rates, every single time the interest rate spikes up, it crashes down during a recession. Spikes up really, really high, crashes down. Every time they raise those interest rates to bananas prices, they'll put into a recession and drop it. Notice when it peaked out here in 89 and then it crashed into a recession. It topped out here in 2000, then it dropped into a recession. They tried to raise it up aggressively in 06 and then it dropped into 2007. Do you not see that there's some patterns here? It went way up in 2019, crashed the system, and now it's going up very, very steeply. This steep curve should remind you of what happened in 04 to 06, but they did this in 1 year, not in 2 years. So these things should be screaming out to you that there's some problems. Now, do you remember when I told you that when the 10-year is less than the 2 year, so they call that yield curve inversion? You see that little flag when it goes below that black line, below, you have to look for that. When you look at mortgage rates and you see mortgage rates where the fixed rate is lower than the variable rate, now we have inverted interest rates. Please see the writing on the wall and try to protect yourself somewhat, because this is a lot of trouble. This is going to be a lot of trouble that is coming down the road for you, and I don't want you guys to get steamrolled. I don't want you to get creamed. And that's what I'm worried about right now, is I don't want you guys to be in some serious trouble. So if you can do something about this now, I think that you're going to be better off in the long run. So let's try to take a look at some prices in Toronto. Let me know if there's an area of Toronto or a city that you want me to look at. I'd be happy to help you out with that as well. So if we take a look at different cities in different locations, we can pick one at random. It doesn't really matter. Maybe I'll pick Oakville for it, and we could just check out what's happening in these different areas. Look at these price swings in the past 12 months. Let's back it up to the end of 2 years ago, and we could try to take a look at what's happening there. We've seen that the prices are very high, 1.8 to 1.5. But you see how prices dropped dramatically and now they have been rising up quite a bit. So that's interesting to me to see that area. Oakville is kind of a unique one. Overall in Toronto, prices have gone up this year, but not necessarily in the high bracket. That's interesting to point out too, though, right? That Oakville, the higher the price, the more wonky it becomes. Notice here, though, if we look at Toronto as a whole, including the low price condos, it is recovering quite well. That's important for us to know. Also, homes are selling really quickly. So when we're going to take a look at the homes are selling, if you can see right here, in 15 days on average. But this not doing this to point out just this one area, because all cities over 1 million people, this is how it's behaving right now. We're also seeing people starting to pay way over asking, which is also absolutely crazy. So if you guys have an area that you want me to check out, please let me know. YZ, you said you never saw inverted rates before. So there's two inversions that we're seeing right now. The number one inversion is that you're not getting any money on your treasury yields. That has absolutely collapsed. That's a big problem. But we're also seeing the inversion in the rates in mortgage rates. And so this is also a problem. Both of them are flagging a real big issue. Remember, fixed rate mortgages are like a security blanket. They should be making you feel very safe. So if we're seeing the rate on fixed rate mortgages be higher, that's normal. So when rates before on a variable were hitting 2% and a fixed rate was at 2.5%, that's normal. It's normally always above. But then once we moved into the fall last year, then it just started splitting. You have to ask yourself, why would a bank be willing to give me that extra security blanket of a fixed rate mortgage for cheaper than the variable? They have to know something that you're not thinking about, right? Why would they be giving away that free security blanket? Come on, guys. We all know the answer. It's because they know that there's a lot of loans in trouble that are going to be coming. Why do you think BlackRock has the largest real estate fund ever amassed, $30 billion, that is going to be put aside to help buy real estate when the price is correct? We are interested, me and you, in also buying those properties at really discounted rates. I can't wait for it. So this is going to be good times all around. It's going to be great for me. I can't wait. Anyway, this is a warning for everybody. I think it's much more important. Please remember, the inversion is a big problem. S&P 500 year to date has been flying high. That's mainly because of the top 8 stocks that are out there. Also, very good chance, 74% chance that the rates are going to be going up again. That's what the markets are betting. Canada did not do a good job at keeping the rates where they are. Our dollar has gone up, though, because we have decided to raise rates. So notice when we raise the rates a quarter of a point, instantaneously our dollar has really recovered. So that's a good thing. We need our dollar to recover. Also, in the 5-year bonds, if we just go back 1 month, they have been on a tear since May 11th. They knew that we were going to raise those rates, so they've gone up. So that's a very good thing. If you guys are thinking of selling your property, of course, you can always reach out to me at sellhigher.ca. Sellhigher.ca is where you can meet me and ask to speak to my team. Also, if you go to sellhigher.ca and go to /products, you can also get our investment property calculators, how to buy your dream home course, and how we buy gold and silver. And gold and silver is a huge insurance policy for all of us. So know that there's going to be a lag of 18 months. I always try to show people that, but please understand what is going to be happening and research on tighter monetary policy. It's going to mean everything for you guys. This is going to dictate your future. So I wish you guys the very best. Please spread the news. Please send this to somebody that you care about. Please subscribe to the channel and hit that notification bell. And I'll talk to you guys soon. Have a great night.